The current live trading price for Beyond Meat Inc. is sitting precariously at 0.97 USD, currently down by 0.010 cents, reflecting a decline of 1.06% intraday as the market grapples with the psychological reality of this ticker slipping into penny stock territory. To see a company that once commanded a valuation rivaling the largest food conglomerates in the world, now trading for less than the price of a single pack of gum, is not just a market correction, it is a total capitulation of the original thesis. The expectation from the broader investing public, and certainly from the harsh critics on social media, is that this sub-$1 level is the death knell, the final signal before a bankruptcy filing or a desperate sale for scraps. The plant-based revolution narrative has been battered, fried, and served up as a cautionary tale of valuation excess. However, the reality is significantly more nuanced and frankly more terrifying for the shorts who might be overstaying their welcome. What we are witnessing at 0.97 USD is not necessarily a corpse, but a company undergoing a radical, surgical amputation of its global ambitions to save the vital organs of the business. The divergence between Beyond Meat is dead and Beyond Meat is becoming a lean, niche survivalist is the tradable volatility we are seeing on the screen right now. If you are logging into your Fidelity mobile app or checking your Robinhood stock trading dashboard, the flashing red number might induce panic, but you need to look closer at the volume and the order flow. We are seeing a massive consolidation of ownership here. The tourist investors who bought into the hype are long gone. What remains are the distressed asset allocators and the high-frequency algorithms sniffing out liquidity pockets. The drop below the $1 mark triggers a very specific and dangerous clock with the Nasdaq exchange, the threat of delisting. This adds a layer of binary risk that transforms this from a growth investment into a high-stakes regulatory gamble. When a stock trades under $1 for 30 consecutive business days, the deficiency notices come out, and that forces management to make drastic moves, reverse stock splits, aggressive buybacks, or desperate PR campaigns. This is the game within the game that you won't see mentioned in a standard earnings recap. Let's dismantle the fad argument for a moment. While it is true that the mass market adoption of fake meat has stalled due to inflationary pressures on grocery bills, where consumers are choosing cheaper proteins over premium alternatives, the core technology and the brand equity of Beyond Meat still hold value. The company recently made the difficult decision to suspend operational activities in China, a market that was supposed to be their golden goose. This move, while painful and resulting in significant one-time charges, is actually a bullish signal for the balance sheet. It stops the cash bleed. It shows that management is finally prioritizing survival over empire building. For investors using Schwab Intelligent portfolios or managing their own individual brokerage accounts, this pivot from growth at all costs to cash flow preservation is the critical metrics shift you must evaluate. The market hasn't fully priced in the savings from this exit yet. It is still fixated on the revenue decline. The price action today, hovering just pennies below the dollar mark, suggests a battle between the algorithms programmed to sell penny stocks and the value hunters who see the brand's shelf space in Walmart and Kroger as an asset that is now mispriced. Think about it. You can buy the entire equity of this company for a fraction of its peak value, yet the products are still in thousands of stores. This disconnect is what drives the speculative fervor we see on investing sites and forums. However, we must not ignore the debt. The convertible notes looming in the future are the sword of Damocles hanging over this equity. If they cannot refinance or restructure that debt, the equity is a zero. But if they can, perhaps through the $100 million senior secured financing they recently secured, then the stock at 0.97 USD is effectively an option on survival with massive upside convexity. When we compare Beyond Meat Inc. to other market darlings like Tesla stock or Nvidia stock, the contrast in sentiment is jarring. Tesla and Nvidia are stories of expanding total addressable markets. Beyond Meat is currently a story of a shrinking addressable market, but of potentially stabilizing market share. It is more akin to the turnaround attempts we have seen in legacy retail or distressed tech. The traders using Interactive Brokers trading platforms to short this stock at these levels are taking on immense risk because the easy money on the short side has already been made. Shorting a stock at $200 and riding it to $10 is a career-making trade. Shorting it at 97 cents to ride it to zero is picking up pennies in front of a steamroller. Any positive news, a new partnership, a successful debt exchange, or a buyout rumor could cause a 50 or 100% spike overnight, wiping out short positions instantly. Now I want you to pause and engage with this scenario. Comment below with your honest cost basis on Beyond Meat. Are you one of the diamond hands holding from the triple digits, hoping for a miracle? Or are you a new sniper entering at these penny levels? And, more importantly, do you think the brand survives the next 2 years as a standalone company? Let's dive deeper into the operational reality. The company has been rolling out Beyond XV, their newest iteration of the burger with avocado oil and a cleaner ingredient deck. This is a direct response to the health halo criticism that plant-based meat is just ultra-processed sludge. By improving the nutritional profile, they are trying to win back the health-conscious consumer who defected to Whole Foods. If this product gains traction, it changes the unit economics. But the market is skeptical. We see the skepticism in the lack of institutional buying. Fidelity mutual funds and ETFs that focus on ESG, environmental, social, and governance, mandates, have largely trimmed their exposure, waiting for concrete proof of a turnaround. They are not paid to catch falling knives, they are paid to ride trends. Until the trend changes, the smart money stays on the sidelines, leaving the price action to the retail warriors and the high-frequency bots. The macroeconomic backdrop is a massive headwind that cannot be ignored. We are in an environment where the cost of capital is no longer zero. For a loss-making company that relies on external funding, high interest rates are suffocating. Every dollar of debt service is a dollar that cannot be spent on marketing or R&D. This is why the SoFi Invest crowd and the Robinhood crypto traders, who often cross over into these high-beta stocks, need to be watching the bond yields as much as the stock price. If rates come down, Beyond Meat's debt burden becomes lighter and the runway extends. If rates stay higher for longer, the runway shortens. It is a race against time. The 0.97 USD price tag is essentially the market's probability weighting of them running out of cash before they turn EBITDA positive. Let's talk about the short squeeze potential. With a high percentage of the float shorted, any sudden catalyst can trigger a squeeze. We saw this briefly when they announced the financing deal, but the rally faded. Why? Because fundamentally the cash burn is still there. Investors want to see run-rate EBITDA positive operations, a goal management has pushed to the end of 2026. That is a long time to wait for a stock trading under $1. The Robinhood fractional shares feature allows smaller investors to pile in, but without institutional support, these rallies are often sold into. The technical resistance at $1 is now formidable. There are likely thousands of sell orders sitting right at $1, $1.05, and $1.10 from bag holders looking to get out at break-even or less of a loss. This creates a supply wall that the bulls have to chew through. For those of you considering self-investing in this name, you have to ask yourself, are you buying a food company or are you buying a lottery ticket? At this price point, the fundamentals of revenue per pound and gross margin expansion matter less than the binary outcome of restructuring. If you look at the options chain on Interactive Brokers, the implied volatility is pricing in massive moves. The market expects something big to happen, either a default or a rescue. There is very little middle ground. A slow drift sideways is unlikely. We should also consider the competitive landscape. Big Meat, Tyson, JBS, Cargill has effectively retreated from their aggressive plant-based pushes, or at least scaled them back. This is actually good for Beyond Meat. It leaves them as the primary pure-play survivor. The clutter in the meat aisle is clearing out. If Beyond Meat can weather this storm, they could emerge as the Coca-Cola of the category, simply by attrition. But that "if" is doing a lot of heavy lifting. The Fidelity Wealth Management advisors would likely tell you that this is a speculative portion of a portfolio, not a core holding. It belongs in the same risk bucket as early-stage biotech or distress situations. The intraday movement today, down 1%, is a bleed. It is not a panic sell-off, but a slow, grinding erosion of value. This is often more dangerous than a crash, because